So thank you very much for joining me in this video. I want to talk to you today about a term that commercial and industrial specialists like to use, cap rate. And it really comes very, very much into play when we're evaluating commercial, industrial, or investment property. But there's actually a lot of things that come into play in making up the value of commercial property. There's interest rate. There's also the rate of inflation that ties in here. Then there's capital appreciation. How much do we expect the property is going to go up over time? And then net rent. I use the term net rent because we want to factor out the expenses that we pay and how much are we actually receiving on our investment. But the thing that ties it all together is a thing called cap rate. Now, cap rate is the return on our investment if we did an all-cash purchase. Of course, we wouldn't want to do that. We would lose the impact of leverage. But in terms of calculation, return on investment, it's as though it was an all-cash investment. We need to talk for a minute, though, about inflation. Government's very concerned about inflation, and rightly so. Their target is 2.5%. We've seen it rising and rising up 6, 7, 8%. And while in some ways that's good, in some ways it's bad. Let me give a simple illustration. Let's suppose you had $100 in cash, and you took that cash and you stuffed it under your mattress. You left it there for a year. At the end of the year, you took it out. But let's suppose during that year, inflation was running at 5%. You've actually lost 5%. Now, you haven't in terms of currency count. If you take the bills and count them out, it's still $100. But it'll only buy what $95 would have bought previously. When you go to buy bread and milk and when you go to a restaurant, you're going to find that your buying power has been diminished by 5%. That's the fact of inflation. For years, investors worked on a guideline of 4% on real return on their investment. What do I mean by that? What I mean is that they wanted, of course, get the cost of living or inflation. In other words, take that $100 investment example. If you put it in a bank and you got 5% in the bank, but inflation was running at 5%, you were just breaking even. You weren't really making money on your investment. You were holding level with cost of inflation. And the rule of thumb, they wanted a true return of 4%. So what they wanted was the cost of living plus 4%. So if the cost of living was running at 5%, they wanted to get a 9% return on their investment. Well, for some time now, we've been getting nowhere near the expected 4% plus the cost of living. In fact, in many, many cases, haven't even been getting the cost of living. A developer friend of mine who builds commercial and industrial condos in and around the Greater Toronto area said he was selling them as quick as he could build them. And I said to him, how much are you working on in terms of a cap rate? And he said 3.25%. So investors were buying, the price was based on a 3.25% return or cap rate. And I said, well, why would they do that? The cost of borrowing of commercial money is more than that. Inflation is more than that. They're losing ground. Why would they do that? The answer is they're counting on capital appreciation. They're counting on the property going up in value to more than offset the shortfall in the immediate return. Let me give another example. During the COVID boom, had a lot of investors in Toronto that were buying condos and renting them out short term. Now, the rent wasn't covering the mortgage and the common element. In fact, they might have to subsidize $1,000 a month. You'd say, well, why in the world would they do that? If they're not getting a return on their investment, not only are they not getting the 4%, they're not getting the cost of living. The answer is appreciation, capital appreciation. If they subsidize $1,000 a month, and yet at the end of 1 year, they could sell a condo for $100,000 more than they paid for it, it was a good investment. Short-term, negative cash flow, longer-term, huge return. And so that's what they did. And certainly if they leveraged it and put in less of their own money, maybe $50,000, they were more than tripling their money by the fact that the property is going up in value. But what happens if property prices stall? They're not going up in value anymore. Then the investor is going to look at it differently. And investors usually look short term. They don't usually look long term. And so they're going to look at it, and if their potential for capital appreciation isn't there, then they're going to want to have a greater return. that means either a higher cap rate, or it means that the prices will have to drop or the rent will have to go up to make it make sense. And so we see upward pressure on cap rates, and it applies the same thing if you're buying investment real estate, being residential rentals. Same principle. If you're not going to see a huge capital appreciation, then you're going to want to have a better price, and we see downward pressure on prices. And that's what we've seen happen. So we've got higher interest rates, higher costs, carrying costs, but a higher cap rate. And if you're looking at it in terms of the long game, the interest rates aren't going to stay up. Prices are going to elevate again when interest rates come down. And it means that right now it's a great opportunity to buy some investment property that you might have to subsidize because of the cost of borrowing. But hey, it's not going to stay high, and you're going to see the prices start going up again. So look for some really, really good buys when it comes to commercial and industrial, and look when it comes to investment real estate. Thank you very much for sharing your time. I look forward to talking to you again next week.